Hey everyone, it's Larry Kotlikoff back with Economics Matters, the podcast. Fred Lane is back. He's our always fantastic guest. Fred is, uh, Fred's brilliant. This is maybe his third, fourth, or fifth appearance on the podcast. But we've got a lot going on in the markets, or potentially in the market going on, potentially going on in the markets. And Fred's really important to everybody who's thinking about investing. Fred's the founder and managing manager of Lane Generational LLC, an independent registered investment advisor headquartered in Boston. At Lane, if you go to lanegenerational.com, Lane, L-A-N-E, generational, one word.com, you'll find that they provide investment management services on a discretionary basis to individuals, families, trusts, foundations, and institutions. And he's doing this through Fidelity Investments. So if you're on Fidelity, then you can invest with Fred easily. The full disclosure, my wife and I are investors in Fred's fund, but I've got no financial relationship of any kind with Fred, except I owe him dinner, many dinners, I think. I'm not a financial advisor, and I'm certainly not recommending any investments of any kind, including Fred's. So this is just an educational podcast, as it's always been. And if you want to have investment advice, please consult your investment professional. I just have a PhD in economics from a place called Harvard, so I don't know much, according to our president and other people in the administration. So let's just be clear.
Yeah.
The Fred is
Well,
a good investor.
Larry, I should add that I'm equally handicapped with two Harvard degrees as well, undergraduate and MBA. So
Yeah,
you and I are both,
right.
carrying
Very
the Scarlet H, I guess we'd call it, as opposed to the Scarlet A.
exactly. So yes. Um, so and I don't want to, just to be clear, everybody gets into Harvard by accident, really, by or good luck or connections or something. It's not it's not like everybody goes there as a genius. Everybody doesn't go there as not a genius. Exactly the wrong way to the guys in my graduate class who were clearly geniuses who could program mainframe computers from scratch, who could build things from scratch. These were guys who didn't finish their PhDs because they didn't have what is called in German Sitzfleisch, which is uh, ass uh, flesh, rear end flesh, which means the ability to sit in a chair and work hard.
Right,
So,
right, right.
people that succeed, no matter whether they go to, you know, whatever school you go to, if you work hard, you push out yourselves, if you look for opportunities, if you have good luck, uh, you'll succeed. And succeed is not just money, succeed is happiness ultimately, because money doesn't really bring you happiness. We look at all these movie stars are getting divorced or committing suicide or on drugs. It's clear that money doesn't bring you happiness, nor does pedigree bring you happiness. I know people that are 70 years old wearing Harvard sweatshirts. It's ridiculous for people to be, you know, uh, parading around as if they are Harvard somehow. Uh, if that's, but a lot of people that floats their boat, and it's silly. You got to make your own way through life. You can't rest on anybody's laurels. Anyway, and Fred has done that himself. He went into accounting after uh, getting his BA from Harvard, and then he went into investment with a uh, on Wall Street. You'll give us a little bit of the background with Donaldson, Jen Rett, and I forget the
Donaldson, Lufkin, and Jenrette. Yeah, I
Lufkin.
became an investment banker. It was actually,
Yeah,
yeah, I came out of business school actually in 73, and it was a terrible, terrible job market. I think there were 15 jobs available to people on Wall Street. I mean,
yeah.
Wall Street hired 15 or 16 or 17. That was it. Interestingly, the biggest hiring group cohort went to Hilton Head, South Carolina, to do a real estate development, and they went bankrupt two years later. So usually, whenever the class flocks to one area or one sector, it's a good opportunity. It's a good calling to get out of that sector, stay away from that sector. Um, yeah. So actually, I still wear a Harvard sweatshirt, but my Harvard sweatshirt is from 1968. It says 68 on it, and it's one of my old rowing sweatshirts, and it looks like it's spent most of
As long
its
as you
time.
bought it, as long as you bought it a long time ago when you were at school, that's great.
Oh no, I got it for free. No, no, it was given to me.
Yeah.
It was one that I took at my senior year.
I've spent all these years making sure I never wore anything that said Harvard
Right.
because I thought it was just bragging. Now I'd like to brag about Harvard because they're standing up against the uh, against this fascist uh, attempt to take over control of the universities and to decide what we teach, who we hire, or what students can come. Uh, and if you read my column at larrykotlikov.substack.com on this compact that this supposedly genius from Apollo runs. I even forget his name. I can't even keep his name in my mind because it's so abhorrent. But he went to Penn, and he decides because he's a billionaire that he should run the entire university system in our country. He might as well decide he wants to run um, dog food. Uh,
Are you talking about Bill Ackman by any chance?
no, not Ackman.
Oh, the guy from Apollo.
Apollo. Yeah, I forget.
Okay, yeah, yeah,
Yeah,
yeah,
I forget his name.
yeah.
Uh, that just, if you're watching Guy from Apollo, this is what we think of you. We can't even remember your name. This is how important you are in the scheme of things in the long history of this country. You will be a blot. Um, uh, uh, you know, you'll be up there with Benedict Arnold in the list of traitors to the American dream. And anyway, there's a good article that I wrote. I think it's a good article about this at larrykotlikov.substack.com, and that's where all of Fred's current and this one and prior podcasts are posted. Fred, uh, after a stint on Wall Street, became an individual private investor. He was one of the original investors in Staples. He's been on all the media all the time, CNBC, just for years, talking about the markets and the fact that he's willing to come to this small podcast. We have about 100 and 30,000 people that this gets to, so it's getting bigger. We started, a couple of years ago, it was none. We got up to 100 and that number, so it is growing. So please spread the word about this. You can get a free lifetime subscription. Just sign up for a week. I'll turn you into a lifetime subscriber for free. And uh, we interview all kinds of people. I interview all kinds of people, rabbis, no, poet laureates, Nobel Prize winners in economics, you name it. Anybody I think's got something to tell you, we're gonna have them on. Fred has a lot to tell us. Let's now talk, Fred, about how you see the market in general, how you see policy, and then we want to, I think today, talk specifically about uh, not the names of the companies that you're investing in. You're probably investing in like 20, 25 companies, right?
About 20,
You
about
have like
20.
20
Yeah.
positions or so.
Mhm.
They're not all, some are short positions where you're trying to hedge the market dropping. Uh, and then you have kind of uh, your position in terms of your uh, perspective on AI companies, which are now comprise something like 35% of the S&P 500. You told me the other day. Uh, so it's a very undiversified purchase when you buy the S&P 500 in the sense of, not in terms of value, it's diversified, but in terms of just uh, uh, right, companies, number of companies, because you're highly concentrated in a small number of companies. The but I do think it'd be good to go through your different positions without naming them, because that's something
Sure.
that if you want to become an investor with Fred, again, I get nothing back except I get to take Fred for dinner because, okay, he's not going to take me to dinner. I'm going to take him to dinner.
Well, I'll take you to dinner. Are you kidding?
Well, no, I think I owe you. In the context of my my saying this, I think I need to not be compensated in any single form by you, but I found that I can sleep better at night. I want to be in the market. Uh, my portfolio is primarily in tips, but then about a quarter to a third is in the market with Fred. And I sleep better at night because I know that Fred is worried about the same things I am worried about, which is Donald Trump decides to make it 500% tariffs on China, and then you got a Treasury Secretary who says that China's days are numbered, and the rest of the world, and then the president says everybody's going to leave China and just start trading with us. What's going to really happen is everybody will stop trading with us and start trading with China. We're probably seeing this already. I mean, Chile had before Trump's second term, we had Chile, I think, trading much more trade with China, perhaps even 4 times as much as no, that's probably an exaggeration, but certainly more than more trade with China than the US. So uh, the idea that we can suppress the second largest, or maybe even some measures the first largest economy in the world, uh, given how we're treating everybody else, given we're made an enemy of Canada, our third biggest, our second biggest trading partner, and Mexico, our first biggest trading partner, how we're antagonizing them. And then we've got Europe that's upset with us. Anyway, Fred, tell us about the big picture as you see it, and then let's talk about how you think about investing in this climate and the individual decisions you've made in companies, A, B, C, D, up through 20 without naming them, but they're not all companies. Again, there's some are positions like short positions, or commodities like gold. They're not necessarily a company. Go.
So a little perspective. So, I spent about 38 years in the investment banking business. I was with a firm called Donaldson, Lufkin and Jenrette, which became a very big firm. We were sold to Credit Suisse in 2000 for about $13 billion, as I recall. And then I left a year later. I had run the M&A group at DLJ, mergers and acquisitions, and I had taken a lot of companies public, and I had incredible experience working with many, many companies. I mean, I literally, this is a level when people exaggerate things like this, but I'm sure I've done at least 500 M&A transactions, 20 a year for 25 years. That's very manageable. And then I went on to start my own firm, Lane Berry, where we also did mergers and acquisitions and occasional private placements. And I sold that to Raymond James in 2009 and stayed there for 4 or 5 years as vice chairman of investment banking, which was kind of a sinecure job, quite honestly. I wasn't satisfied with the ability to impact the firm and its strategy, which was fine. And so I was well compensated, and it was low pressure, which I don't like. I like high pressure. So I started managing money at Raymond James, and then we went independent in 2020 during the COVID crisis. So Lane Generation's been an independent firm since 2020. And the first 5 years managing money, 2015 to 2020, 21, we were very focused on growth companies. So we looked a lot like a lot of other firms. And let me emphasize, even though you might think of us when you go to our website superficially, you might say, "Oh, this is a wealth management firm." We are not a wealth management firm. We're an investment management firm. The distinction being that we manage these portfolios actively ourselves, and it's essentially in one strategy. We have a second strategy for people who need cash, and it's been extremely successful, ridiculously successful, not to be replicated because it's been very heavily precious metals focused. But we basically manage in our existing main strategy about 125, $130 million, something like that. And it's in one strategy, it's discretionary, and we select stocks entirely. Now, we have occasional C-suite executives who say, "Well, gee, I already own X because I'm the chief operating officer of this company, so you can't buy the stock, or please don't buy any more for us." We've had a couple of those situations. That's easy. We segregate that or take it off, put it on our restricted list. But basically, we have about 20 or 22 positions at any point in time, could be as few as 18.
I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast. Okay, so here's a quick question. So I have my funds with like retirement accounts. I'm investing with my one of my IRAs in Lane Generation.
Right.
So it could be regular assets or retirement account assets, Roth or non-Roth, but
Right.
I'm doing it through Fidelity. If I was with Merrill Lynch, I could do it through Merrill Lynch. If I could do it through
No, Fidelity is our custodian.
Okay.
So we're on the Fidelity platform. We manage the money ourselves. Merrill Lynch doesn't offer us as a product. Although firms like a Raymond James offer Poland Capital or Hennessy or some of these firms.
If somebody who's listening, and again, I have no kickback here.
I understand.
Who's not connected with Fidelity, wanted to invest with you, they contact you, they'd set up an account.
Right.
And then would they set up an account with Fidelity and then invest?
Well, no, they set up an account with Lane Generational, but it's on the Fidelity platform. So they can look at it every day on Fidelity.com and basically go in and look at their Lane Generational allocation, and they can get into the specifics. I mean, our clients could invest with us.
So the custodian is going to be reporting.
And literally, well, from a reporting perspective, it's all there. And of course, we do 1099s at the end of the year. We can do tax harvesting as needed for clients, i.e. offset gains with some losses where available. In the ideal situation, we never have losses, so people have gains and they complain about that, but that's the way the tax system works. But basically, people come to us and we're typically, not always, we typically manage a good portion of their assets. You're fairly typical, Larry, in a way. We manage a percentage of your assets, not all your assets. We don't necessarily seek to do that. I happen to have virtually all my investable assets in public securities, at least, with the Lane Generational strategy. I live it, I breathe it every day. I have family members who are involved and very good friends. And so we tend to be pretty conservative. So I wanted to just say one thing, and that is that where we take short positions or we hedge a position, what we're doing is we're either deferring the tax, so we don't have to sell it to be less exposed. For example, if we have company X, Larry and I were talking earlier today about an AI related company that we bought at $20 a share. It had traded at 52. We love the entry point at $20. We didn't expect it to go to $129, which is where it is right now, within 7 or 8 months. That's kind of, being struck by lightning in a good way. And so we don't want to sell the stock ideally because it gives rise to short-term capital gains. So we've hedged that position by using an index tied to the QQQ, because if the QQQ goes down a lot, then this stock will likely go down a lot. And it's not tied specifically to that company. I mean, one of the dangers of company-specific shorting or hedges is that, if let's just say I love a certain software company, but I really hate Salesforce. I don't hate Salesforce. But then you have something happen like today where Salesforce is announcing their agentic AI, and suddenly the stock's up 6%. So you can have specific situations where you may be negative on a stock, but something happens and the stock really, really appreciates rather unexpectedly and rather extremely, because we have great volatility in the market today. We want to basically hedge very big positions that we think are good, but we think in the short term could be subject to a reversal. And by the way, we've been doing some of that in precious metals. And when I say precious metals, we're talking about gold and silver. And we express our interest in precious metals. We've been in precious metals, by the way, since 2022. So that has not been as rewarding as one might think, looking at recent results. It's been real rewarding, by the way, but recent results are totally absurd. I mean, we have stocks that are up 60, 70, 80, 90% year to date, gold miners, silver miners, because of this newfound attention to the fact that the currency debasement is a U.S. problem. It's a global problem too, by the way. It's a particularly U.S. problem because we are the reserve currency for the world. And so, we look at that and we say, okay, we want to own precious metals, but rather than buy gold, which we could do, we instead have owned the miners. And the miners have been they're leveraged to gold, right? Because if gold goes up 10%, their margins may go up 40% because they have certain costs to extract the mineral. So, we basically will hedge our.
Just to be clear, the cost won't go up dramatically, but the price that you can sell this stuff at will, and that's why you get this, in effect, leveraged. Leverage, another word for a multiplication, really.
And what a gold miner obtains selling an ounce of gold, processed gold, is not the full gold price today, which is remarkably in the 4,200, 4,300 range. This morning it's been explosive to the upside. And so their costs, like right now, oil prices are down. That's one of their major cost inputs is for energy. So that cost is down actually. And the prices they're obtaining, which is, are also up. And there's a lag effect too. If gold increases 10% in the next week or two, or has increased, that much in the last month or more, that's going to get reflected in future sale prices, not necessarily not backward looking. It's not reflected in their revenue. So, gold and silver has been a major part of our portfolio. And frankly, we put it in place largely we thought it had a lot of upside, but we also put it in place because we thought it was pretty defensive. There's obviously a lot of geopolitical tensions out there. We know he's talking about Russia, Ukraine right now, but obviously we have that cauldron. We have the Middle East. We have an ongoing trade war with China, which could escalate to more than that. And that's been going on for a couple of years, for sure. The trade war longer, actually. And so for a lot of reasons, we think gold and silver have been pretty defensive. Now, having said that, it became such a large percentage of our portfolio, close to 25%, maybe a little over that we decided to hedge some of it with a short vehicle so that our gross exposure of 26% was really reduced to something like 16 or 18%. So we're still very long gold.
Yeah. Let me ask a quick question, which is, so you have one fund and you've got some retirement account investors in that fund, and you've got some regular asset investors. So you've got the capital gain issue. Had you ever thought about setting up two funds, one for the retirement account investors and one for the regular investors?
No, not really, because and we don't really we're not hyper focused on tax impacts.
Okay. No.
We don't want to be hyper. That's letting the tax tail wag the dog. Now, one of the things we have thought about is creating a private investment partnership and not having this current structure, because it would enable us to hedge our winners much more cheaply and much more effectively through options than the techniques we use now. Now we use leveraged ETFs. They're okay, but they're far more expensive. We tie up more capital doing that. Now, as you know, Larry, from your experience, our performance hasn't suffered too much from all that. but nonetheless, there's a more efficient way to doing what we're doing. But right now, people invest with us. They pay a 1% fee. We manage the assets, 1% of assets under management, 0.25% per quarter, and they have liquidity when and as they want it. So it's not like investing in a private partnership. It's not like investing in private equity or real estate or anything like that. If you want liquidity and need liquidity, you could have it, or some portion of it. You could take some
So
money out.
one question on that, on getting involved with you. I mean, again, we don't spend too much time on that, but uh, is there a minimum investment for people?
Yes, the stated minimum is $500,000, and I would say that for people who are, it's going to depend a lot on profile. So if someone walks in the door or calls me up on the phone and he's 25 or 30 or 35, or she's similarly aged, or maybe 45 or 50, prime earnings years, likely to invest more with us, we compromise on that minimum. If someone is a lot older, and they're stretching to get to 500,000, then we probably are a little less flexible in that regard. And in every case, we want to remind our clients that the pattern of investment returns is it's not a straight line. Okay, there's a lot of noise along with the signal. The signal may be up, but there's a lot of noise, and so we
I think what Fred is trying to say here is that, uh, Fred is not a spring chicken, neither am I. We're both into our jobs because we love them. And Fred
Mhm.
doesn't need this job. He could be retired. He's doing this because he enjoys it and because he's trying to help people. And if he sees somebody trying to put all their money into his still risky endeavor, I think it's less risky than the S&P personally, but because it has some protections that you wouldn't have from just the S&P. Uh, that he will not necessarily take you if he thinks it's going to be not in your interest, if it's going to put you too exposed. So that's not because you don't have enough money or because you're too old or blah blah blah. It's really, is this really good for you? That's what when I went through with for Fred, he sat down with us and said, my wife and I, what's your situation in general? Because I want to understand that before I take you on. And that's remarkable because everybody out in Wall Street is just chasing assets under management to charge fees. Fred doesn't need the money, as far as I can tell from visiting his houses, or by Zoom or by physically.
Right.
Um, and that's the kind of person he is. So that's one of the reasons I love having him on, because we're talking to a real person who's not trying to promote himself per se.
Larry, one thing I want to emphasize here, and I know I've said it before, this is my money that we're investing. Now, it's my client's money too, but every trade done is a block trade. So, if we invest X amount of money,
Yeah.
some percentage of that is attributable to me, some percentage is attributable to you and to Bridget. And so I think of the portfolio, it's 18 to 20 names fundamentally. I think of the portfolio as being fundamentally, this is me, conservative. Okay. Well, gee, you own this little company in the satellite business. You own this emerging medical device company. And we've done the research on these companies. And frequently we buy into a company and it trades down. And I'll give you a great example of a company we've owned in the past. We don't own it today. And I shouldn't be naming specific companies, but since we don't own it, I'm not recommending it necessarily. I have a point of view on it. We invested in Palantir back at $8 a share about 3 years ago. And Palantir is a leader in AI, both for the government and for commercial application. It's run by a guy named Karp. And it's a pretty terrific company. Having said that, we invested at 8 and went to 6. We continued to build our position. We were convinced. At 22, 23, 24, we started selling some stock. And then the stock went up and it became again an 8, 7 or 8 or 9% position in our portfolio. So we sold some more at the 40s and 50s and 60s, and finally sold out all our stock in the low 100s, 108, something like that. And of course, now the stock is about 180. So now we took the proceeds, by the way, and invested in other things that have done just fine. So we're not kicking ourselves too much. But having said that, we thought at 40, 50, 60, it was pretty fully valued.
Okay.
And what has happened today is that momentum takes over in these stocks. And as much as we want to ride the momentum on behalf of ourselves and our investors, we're also very cautious. We're pretty cautious about these things. So we have had a tendency to sell out. We sold out of NVIDIA too early. We sold out of Palantir too early. We have another one where Company X that you and I were talking about earlier, which we bought in at 20 and now is at 129, but it's short-term capital gains. So we're trying to get to the finish line to get long-term, but we've sold some stock already. We think it's very fully valued. And we also think that the AI mania is a little bit overblown. Okay.
Want more money, less risk, and a better life? Buy Money Magic, a new book by Lawrence Kotlikoff, Boston University economist, personal finance expert, and best-selling author. Whether it's education, career, marriage, housing, investing, retirement, Social Security, IRA, or 401k decisions, Money Magic delivers scores of secrets to raise your living standard. Financial journalist Jane Bryant Quinn says Money Magic is a must-read. Nobel laureate George Akerlof says Money Magic is quite probably the best financial advice book ever written. Financial guru John Malden says, you'll love this amazing book. It's full of wit, wisdom, and startling paths to a better financial life. And columnist Scott Burns calls Money Magic a funny, brilliant read, offering wildly powerful, unconventional choices that can literally change your life. Get Lawrence Kotlikoff's Money Magic today at Amazon, Barnes & Noble, and independent booksellers.
Let's talk about Andrew Sorkin, one of the famed writer for the New York Times and author, just wrote a book called 1929, and it's about, I guess I haven't read it. It's very thick. It's probably a great book, and he was just interviewed on 60 Minutes with Leslie Stahl, who's I think 84 now, looks great and is going strong. It's terrific. She asked him point blank, is this 1929 before the crash?
Mm-hmm.
And, there was some ups and downs before the crash. And the crash wasn't that massive. I think it was like 20%. And then the market, I think, continued to fall. And then I think it rebounded in 30. And then by 1933, after a third of the banks had failed, we had the market in nominal terms was down 86%. In real terms, it was less because we had deflation, maybe more like 60% or so, but pretty big. We saw in 2000 a 50% drop in the S&P over a short period of time, the dot-com bubble. We saw a 53% drop in the Great Recession between 2008 and 2009. So the market can drop again. Do you think this is 1929 that we are about to face? I know you can't say, nobody can say, but do you think things are just so bizarre? I was reading something that the top 10 AI companies, none of them have a profit showing, maybe I misread it, but I think it said that none have a profit and some are selling for 100 times revenues or something.
Well, the one I mentioned earlier, Palantir, sells at least 100 times revenues, 125 times revenues. No, fundamental analysis, it's very difficult to apply fundamental analysis to AI companies in general. We estimate that close to 50% of the gains in the stock market over the last year, or year to date at least, have come from AI related companies. And so the AI, and it used to be that people looked at the stock market as being a reflection of the economy. Today, I think the stock market is one of the determinants of the economy. In other words, if the stock market is strong, that creates capital flows, and that creates capital availability. And by the way, and when that is strong enough, that can create excesses, as we know, which we happen to think we're in a bit of an excess right now. We look at a lot of technical indicators, we do a lot of fundamental analysis, but we'll look at a specific company. We'll look at even gold right now. Okay, we'll look at gold miners, and we'll look at gold itself, and we'll look at what is the relative strength index. And below 30, it's like you got to buy it. I'm talking in general. And above 70, oh, you got to sell it. Well, right now, I think gold itself is trading at something like an RSI of 81, 82, 83. Now, does that mean gold's going to collapse? No, it doesn't necessarily mean that, but it means to be cautious. And I think that the AI bubble, okay, and I consider it to be a bit of a bubble, yes. And the reason I do is very simple. We're basically investing trillions of dollars in AI hardware. We're investing trillions of dollars in AI development. And, this reminds me a lot of, how many survivors and thrivers, how many thrivers are there going to be? We've got a lot of strivers. How many will thrive from AI development when the investment in hardware is 2 trillion? If I'm Meta and I'm investing 500 billion, okay, what kind of return on investment incremental to my business do I have to get on that $500 million investment? Well, I've got to get like 20%. That's $100 billion. Well, $100 billion on Meta is, that's a big percentage of their current earnings. And so if you look at Meta and you look at Google and you look at a lot of these companies, Microsoft being a little bit of a compromise in this sense, but all of these companies have been very highly profitable software companies, generating cash flow, not having big reinvestment requirements. Now they have created a capital structure and an investment posture that makes them not look like the traditional software companies. They're not. They're basically much more like utilities or railroads or something like that, where you have to invest lots and lots of capital with the expectation that you're going to gain share and gain incremental profitability. And I think the jury's out on that. How many of these models, AI models, are going to be successful? We're talking about the large language inferential models, the training models, the agentic models. How many are going to be successful, and how are people going to pay for them? Now, the optimist in me says, and Larry, I know you'll agree with this, that a lot of our economic growth over the last 20 years has been technology driven. It has not been driven by necessarily huge increases in population. I wish our population were growing at a more rapid rate. I'm not worried about global overpopulation. I'm certainly not worried about overpopulation in this country. So I'd like to see more jobs created. But by the same token, technology is making people more productive with less work, quite honestly, which is not a bad thing. And so, I'm hopeful that AI will generate the same kind of outcomes. But I think the jury's very much out. We're very early in the game, and the fixed capital investment being made in AI, again, reminds me of the fiber optic cable industry, the WorldComs and all those companies back in the day. And this was 25 years ago, when 90% of the fiber optic cable that was laid black, was never used for a decade.
Or the .com bubble.
Yes.
If you think about 10 major AI companies competing with each other, if we're talking about search engines and then somehow advertising connected to that, getting rid of traditional search, I always use Google for decades now, whatever.
Me too. Sure.
To search. Now I go to Perplexity AI for most questions.
My favorite too. I like Perplexity.
When I want to double check, I ask Perplexity and then several others, and Perplexity's charged me like $20 a month or something.
Right.
So, but that's not going to make their day or cover all these kind of costs. And other people might go with ChatGPT. The answers are pretty similar. Perplexity seems to be more accurate, more precise, detailed. The other, and they're not, none of these answers are really exactly right. They're not.
Right, exactly.
A lot of them are just really spitbacks of stuff they've grabbed from the web. They're exact word for word spitbacks.
Mhm.
You know, you ask them a question about Social Security provision, you might have forgotten 22,000 pages of rules, one particular rule you forgot, they come back and it's actually, then you see the source and it's exactly quote, you know, word for word from the Social Security program operating manual system.
Right.
So that's great to be able to get that quickly. That saves me maybe half an hour of searching around. So for me, it's much more productive. Will it be able to, I'll just give you another example. You know, we have the software Maxify Planner, and I was talking to somebody yesterday about who's got an AI type company that about using, you know, setting up a bot to help our clients navigate our software.
Mhm.
We have lots of help, online help and different services, co-piloting, flight check services, concierge services. So people that need help, but most people just get it on their own. We've got, but there's some, but having somebody there to kind of talk to, not somebody, a bot type thing there to talk to seems worthwhile. But then I thought about it, you know, and we probably may get a company to provide bot type help, kind of a personalized AI financial tour guide here.
And
But
it won't necessarily lead to your laying people off. It will just lead to, frankly, broadening the market.
might lead more sales and keep up with the
Absolutely.
competition. And
Absolutely. That's where technology,
yeah,
everybody likes to focus, oh, gee, the unemployment rate's going to go way up and people are going to lose their jobs. And so maybe, but I also think it enables us. I mean, for example, in our case, and this is where now I'm kind of talking the ugly side of the story. We don't need to hire, more than one or two of additional research people as we get larger, because we use a lot of AI tools to summarize, to condense, to deliver perspective. Then we can dig in. Okay, we will look at a company. Jack and I will come across companies. All the people say, "Where do you get your ideas?" You name it, we get it. Different sources, talking to other money investment managers, reading a lot, newsletters, talking to people, just everywhere. And we came across. We have a watch list at any point in time, 10, 15 companies, maybe more. And Jack was going through this, my investment partner, Jack Shibley, was going through this list. And he said, Fred, the average stock in that group is up between 50 and 100% in the last 3 weeks. It's like, oh, I guess we missed the boat on that. But the fact of the matter is that's part of being in a frothy market. And it's part of being, and part of our job, in our view, is to do the fundamental research. So if we buy into one of these stocks and it goes down by 10%, we want to buy more, or
so
20%.
the AI, because it's kind of like a system of finding out, uh, finding out what people are saying, what people know. It's like a way of accessing a public good, which is public information.
Yes.
Information that's publicly available for free.
Right.
So you're taking something that's fundamentally free that nobody has kind of a property right over,
Yeah.
and providing it instantly to people, which is great. That's, providing what is known, what people think in general, even though it might not be fully true, although they might be reporting it accurately. The beliefs out there may not be correct, or the wisdom out there may not be correct, but there's nothing unique. It's not like they have a particular patent that they're exploiting, any of these companies. So they're all
Right. That's exactly right.
they're all accessing the same
That's exactly.
information, and there may be ways where that information becomes sellable to these companies so that they can't actually just grab it. And so that's the sense in which, but getting back to my little company and thinking about it. So for this company that we're talking to put together an effective bot, they're gonna have to do a lot of uh, work. Okay. It's not
Sure.
like they can take a large language model, which is collecting general information, and be able to use it to say how to navigate our software, or how to best, after you've done these three things, to give the best suggestion for doing the next three things, which is kind of like we like to, give people, although people figure that out themselves, we'd like to say, well, have you thought about are you spending more than we actually than the program suggests, or is affordable, or are you spending less? If you're spending less, how does that impact your thinking about investing? Because if you're spending less, then you can invest, then you can spend, if you invest safely in inflation index bonds, for example, then all you're doing is facing downside risk to your living standards. So are you investing for your heirs, in effect?
Right, exactly. Well, that gets to the suitability issue that you were mentioning before.
And then have you use the estate planning aspects of Maxify? That's the kind of thing that getting that bot to know will require training that bot, and it's not going to be on some big, facility that Microsoft just spent, or whatever Amazon spent $500 million on, and built their own utility system to make energy. I don't get it, how that can translate into helping individual companies, where we would pay them to instantly provide us a bot, compared to this other company that would, be doing that. And maybe they're using those other facilities. So I don't know exactly where the money is, but I do agree that it's a bubble. Let's talk about your 20 or so positions, and how you got to them.
Well, let me go back to something that we discussed earlier, which is you mentioned the S&P 500. People who invest in the S&P 500 should be aware that 10 stocks now account for about 35% of the value of the S&P 500. So when you invest in the S&P 500, as you put $100,000 there, $35,000 goes into 10 stocks. And by the way, $65,000 go into the top 50. So the idea that somehow this is highly diversified is not true. And because
it is diversified across value, it's not diversified across company.
Yeah. Oh, absolutely. No, right. And that's the whole problem. The problem is it's market cap driven. Right. And so if you believe, as we do, that there are certain companies in that top 10 that are very, very highly valued, if not, unsustainably valued, then when those roll over, and they will pull down the whole index. I mean, as an example, when NVIDIA has a very strong day, it can account for the whole gain in the S&P 500 that day. It's pretty remarkable. So we tend not to own the only large cap company that, and I don't mind mentioning this, it's fine. A lot of people will own this stock. We own Amazon. Okay. But most of the other companies in the portfolio, clients would be hard pressed. Most clients wouldn't know what they are. Now, these aren't small companies necessarily, but so we own a combination. I mentioned earlier, gold and silver miners. We own 2 miners and 1 royalty stream company, which basically gets paid royalties on revenues out of various mines. So we own that, and that's probably 25% of the portfolio, something like that. And again, we have a hedge against that. And then the rest of what we own is tends to be smaller or mid-sized companies that have very good growth potential, where we believe that we've invested at a very good entry point. Entry point is critical. I find it amusing that now financial advisors, over the last 3 months, I'm reading everywhere, they're all recommending gold to their clients. Well, that's a little bit like like, let's buy at the top. Now, we're not saying gold is not going to go higher. We're actually pretty bullish on gold. But having said that, what we want to do is we want to buy company X, the one I mentioned earlier, which is now our largest position, and we keep selling it down. It's still about 9 or 10% of the portfolio. We want to buy that at 20 and have it go to 129. We don't want to buy it at 100, have it go to 129, because the risk return there is not that attractive.
Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, M-A-X-I-F-I, Maxify.com. Now let's get back to the podcast.
So,
Can you tell us remind us what field that company's in?
it's a very large international data center company. They actually build data centers and manage data centers.
So it is connected to AI.
It's definitely connected to AI.
But you're saying rather than buying the AI companies themselves, you're buying things the AI companies have already committed to
correct.
Purchasing.
Correct.
So they're kind of locked in if they're going to, even if their profits go down and their stock value go down,
Right.
this other company is going to get, has long-term contracts, I guess, to feed to do for these AI companies what their mission is.
The growth of this so-called neo-cloud data center company over the next couple of years is, we believe, pretty predictable. They've won a couple of big and they've got a couple of big new customers. I mean, it's incredible. But having said that, we remain skeptical about AI. So, will we own this stock? We bought it very serendipitously, very attractively priced, and we're very happy with it. But, we're very cautious about it right now, and we're very cautious about AI.
This company is, if you think about it, you said it's a large company. Is it physically a large company? I mean, do they have lots of
I mean, they have
hardware sitting around in some place in Montana?
It was originally based in Europe, and now they're building some centers here in the United States. And but that's a great example of a company. But then again, that we find very attractive. But will we own it in 5 years? I don't know. We have a medical device company that is very instrumental in delivering specific gene therapies for central nervous system and brain lesions and brain problems. It started off as an equipment company targeting areas of the brain, and now they've developed instruments to actually go into the brain and deliver drugs. It's an incredible company, quite small. I mean, we're talking a market cap of well under $500 million. And Jack and I believe this is a company that could be, it could appreciate by 5 or 10 times.
So their delivery, they're not making the gene therapy. They're just
no. Here's what's interesting: they're working with a number of gene therapy companies. So the great thing about them is that when a gene therapy company develops a drug and gets it FDA approved, they will participate. I mean, in one case, there was an announcement made a couple of weeks ago about one of these companies that had this therapy, and they're going to charge $1.5 million for it. It's a very, very rare drug, but it is a solution to Huntington's disease, and they'll get a measly $20,000 per application. Well, $20,000 per application will really add up for this company, and that's just one of many. So, in a sense, it's a tool. They sell tools to people who are delivering certain gene therapies. So we like that company a lot. We've got a company in the satellite communication business, that basically radio frequency for weather and particular climate change, so on, which is a global company. So people will forget that, or think perhaps, well, do these guys invest in growth? Yes, we do. Do we invest only in the US? No, we don't. We have investments, as you know, Larry, from looking at the portfolio. Most of our portfolio is US. But if a company is based in Argentina or Brazil or Amsterdam or something like that, and we have done the homework and feel very comfortable about it, we have no problem taking a position in it. So, and
You hedge the currency risk or not really?
we most of these are dollar denominated, so there is not it's quite the same. There's some currency risk in these companies, but because these are multinational companies that go to some extent that
I think, by the way, just in
currency
general,
risk
I think currency risk is a good thing to have because I
right.
think when your country, I think taking on a currency risk is, if your country depreciates, it's probably when you've lost your job, and
Right.
having a uh, having a company that's got, a capital gains in dollars because the dollar depreciated, and you're holding, let's say, euros in effect through that company, that's a good thing. So uh,
Exactly.
currency hedging is probably not recommended by economics. Uh,
Absolutely.
yeah. So, but tell us what you're thinking. Okay, so you have these kind of uh, off the uh, off the highway uh, specific company now, and when you do your homework, I think you talked about this last time, or maybe you talked about it to me in private. About I asked you, gee, Fred, don't you really need an economist to help you figure this stuff out? And then you told me about the 15 things you do in researching a company, none of which I have any, knew about or would know, to look at. And I always said, oh, you don't really need me. You're doing exactly the right. Tell people a little bit about the way in which you do your research.
Well, I'm a CPA by training, and I spent 38 years as an investment banker, taking companies public and doing bridge loans and doing convertible debt offerings and buying companies, selling companies, doing takeover defense. So, I'm pretty experienced in looking at companies at the financial statement and footnotes level, and pretty experienced in looking at projections, questioning projections, being skeptical about projections, doing what I'll call fundamental due diligence. What is the company all about? How strong is its competitive position? We also use expert knowledge networks. So we subscribe to services which allow us to look at company A, and we look up company A, and we want to look at former executives of company A who express knowledge about the company. Could be a marketing guy, could be a finance guy, and we basically get to interview them, or we get to listen to more often transcripts of prior interviews, so we can read through it. And because people, investors typically will ask similar questions, so that gives us some insider perspective, as it were, or perspective on the culture of the company, what's very important to us. Now, in many cases, I know these companies. As I said, having been on Wall Street for so many years and playing the roles I played, I estimated that during my career, we looked at something like in our banking review committee, looking at prospective clients and client engagements. I looked at something like 8 to 10,000 companies during my career. Like, that's mind-boggling, right? But somebody would come in and say, "Hey, we're going to do a public offering for this big public company. Here's a little profile on it. What do you think?" It's a check, no brainer. But there are other companies that probably 80% of our discussion focused on 20% of the companies, and 20% of the discussion focused on 80%, which were easy. But after a while, you just get to have this knowledge of companies. And by the way, that can be dangerous for Fred Lane, because Fred Lane's been at this for 5 decades, and Fred Lane better be careful not to think that he knows all about a company when it's changed dramatically, right? So we read the 10Ks, we read the 10Qs. We do use third-party research. We have 2 different Wall Street firms from whom we buy research. I have a metals and mining analyst, I should say, former Donaldson, Lufkin, and Jenrette, all-American analyst. He's on retainer with us. He's an incredible resource to us in the metals and mining space, which is not a space we've necessarily focused a lot on other than precious metals, although we have owned uranium in the past. We don't own it currently. That's going to end up being someday a pretty good place to be, but I think that's pretty far off in the future. And then in addition to all of that, we can arrange calls with managements. And so if we like everything we see, okay, and we say, okay, we really want to take position in this company, then we look at the trading. Okay, where has it been trading? Where is it trading currently? What is the DeMark indicator? The DeMark indicator tends to look at, we like to buy companies that are on a strong price downdraft. When they get to 13 weeks down in a row, that's a good time to buy the stock. It's almost compelling, particularly if we like the fundamentals. But even as a trader, which we're not doing, we're not traders. But even if we follow those DeMark indicators, it tells us when to buy, it tells us when to sell. So likewise, if we've owned a position and it's up to a 13-week high, we tend to want to lighten up the position at that point with some sensitivity to taxes, obviously.
Let me ask you something that strikes me. You said you've looked, in the past, maybe 10,000 companies, which is like 10,000 potential, people pitching who
Right.
are entrepreneurs. I just read in today's one of the papers online that our country is trying to restrict immigration to whites. That there's a
God forbid.
so can you give me a perspective? Give me a perspective, if you could, on give us a perspective on the background and composition of the people of the 10,000 people out there, the ones who are probably to a large extent driving the growth of this country, and whether they fall into any category. I mean, in economics, in my area of academia, I've seen brilliant people from every corner of the world.
Right.
Whether it could be Turkey, it could be India, it could be Costa Rica, it could be Colombia. I mean, just everywhere. Argentina. They're brilliant economists. They're not all white Americans who went to Dartmouth
Thank God.
and played football
Or hockey.
or hockey. Uh, there's just there's something. So tell me about the nature of American entrepreneurs and how many are foreign born and are recent immigrants, and why is it that we're such a good place for technological change, whereas are people flocking to the U.S. and are they going to start now not flock? Give us your perspective on the policy impacting our growth potential. Clearly, we have lots of uncertainty about tariffs and so forth. Let's set that aside, but just the whole immigration issue and the deportations and all that climate. I know people who are refusing to come. I have a fantastic co-author. He's at a middle-ranked university in Germany, but he's brilliant. He's together with him, we're making enormous breakthroughs in an area of economics that's been stuck in the mud for 40 years.
Yep.
Because of his brilliant insight about how to solve a very, very, very tricky computational problem. And our department would love to hire him. I asked him the other day whether he would come. He said, "Well, not with this political climate, not until the country gets back to normal." And he would not have said that before the last election. He would have come.
Well, actually, I'm a little surprised because Germany has its own issues, as do France and the UK to an even greater extent.
Yep.
With the absorption of immigrants. I mean, first, I'm a second generation, and so
I'm third.
yeah, and I glorify immigration. And by the way, I won't get in. I did a rant on this during our last podcast, but I won't do it this time. I'm in awe of the Jewish tradition. Okay, I was brought up in the Judeo-Christian traditional values, work ethic, blah blah blah, classical education, the whole thing. I think, but having said that, a very significant percentage of the leadership in technology companies in the United States today are not foreign born or they're first generation American. They're Asian, they're Indians, it doesn't matter. I was at a conference on longevity and wellness.
They are foreign born or they're not foreign born?
Many of them are foreign born.
Oh, many foreign.
and I'd say at least half. And then a significant portion who aren't foreign born are first generation. So they're, you know, my parents came from China, my parents came from India, whatever.
Yeah.
I was at a conference on longevity and aging and wellness, sponsored by MIT and Whoop, the wearable band company, 2 days ago, and I was struck by how many of the cutting edge research people. And there was a guy from Google, as an example, talking about the use of AI in medical research. I was just struck by how many of the speakers were not Americans, or were not clearly, they're not, you know, like third or fourth generation. So I think, I mean, the best and the brightest in many ways, the best and the brightest in this country, and sorry to say this, but this is a generational comment, not true of my 42-year-old and 40-year-old children who are obsessive competitive people, but there's too much complacency in this country about, oh, we're great, we're just great the way we are. And I think people who come from the outside, who come from a perspective of living in a 500 square foot house and worrying about clean toilets and clean water and things like that, they come to this country, they're not spoiled. Okay, they're saying, this is the golden fleece. I have found the golden fleece, and I'm going to work to create it for me and for my children. And that's that. I mean, I want those people so desperately. I think they're really, really important to our economic growth. Why do they come here? Because we've got lots of capital. We have tons of capital. I mean, the capital creation, the wealth creation in this country over the last 40 years is breathtaking. If my father, who was long dead, died 50 years ago, if my father saw my lifestyle and my wealth without taking necessarily a lot of risk, he would be shocked. He was a physician, by the way. And he would be absolutely shocked. He'd be delighted, but he'd be shocked. He'd say, you have how many houses and how many cars and how much net worth? But that's been enabled by the system. That's been enabled by this. I'm sure, Larry, you feel the same way. It's been enabled by a system of education.
Yeah.
And
just to say that I'm super concerned about the way we're not educating our, you know, Americans born here. And
yes,
if we started
yes,
getting serious about, you know, in Switzerland, a full professor in economics is paid the same amount to the dollar, or to the Swiss, I forget what their
just Frank.
Swiss franc. Yeah, that's right. To the franc as a kindergarten teacher. That's how much they
Yeah,
size education,
right,
and not all their kids are going to college. When they have a
right,
small fraction going into college, so they understand that the college, you know, that studying, you know, that there's a diversified set of things you can do with education, and it's not. So a lot of people are going to trades in Switzerland, a good share, much larger share than in the U.S., but they have a very educated population. We have people that one generation after the next is getting lower and lower scores in terms of
right.
reading to grade level, math to grade level, international PISA scores. So this is partly why you see a lot of foreign-looking people with accents at these meetings, is because they had really good educations or better educations, or their parents educated them, or they educated themselves. And they had the Sitzfleisch, the Sitzfleisch that we don't have, or we haven't given our kids, or so I think that's
Too much of this. Too much of this.
much of
This
this.
is a big problem. And AI is, this is one of the dangers of AI is the kids don't need, and they've done studies which show over a 3-month period, if you can use your phone for research or not use your phone for research, or you can use your phone to write, the more you use your phone as a student, the less you learn. And the less, I mean, you know, frankly, there's not absorption. You generate answers like a mechanic. Well, that's not useful in the real world, because ultimately we want to learn to think and to analyze, right?
Creativity is something that's practiced. It's not
Exactly.
there out of the blue. It's, you have to, and
Exactly.
you build one thing that's small, that's different, and then from that you can build something else. That's generally uh, how technology
Then
progresses.
you think about the dangers of this as it relates to political thought, political opinion, influencing people. I mean, the AI has already figured out, or will soon figure out to an even greater extent, what Fred Lane likes and doesn't like. Anytime I open my phone, it'll be targeting me for, gee, Fred must be really into weight training because or cycling or whatever, which is true. And so the fact of the matter is, but it can influence my political opinions too. It can cater to my political thought. You and I don't necessarily see eye to eye on all things political, although increasingly I think we do. And so, to some extent, the problem with that is I don't want to live in an echo chamber. I want to live. One of the reasons I so enjoy you, Larry, okay, is you have opinions different from mine. That's good. If I believe in my own opinions without ever questioning them, that's a trap. I don't want to be in that trap.
By the way, this guy, this compact on for the universities are being told to sign is requiring every department, every college, every department, every unit within the department to have ideological representation, including conservatives. They explicitly say that. So we're supposed to have universities that have ideological debates at the water fountain. We don't want ideologues. Just to make it clear, no university should want or college should want an ideologue anywhere near the campus, because ideologues have fixed opinions and academics are there to change their mind. Finding truth is you have to start with the idea that you can be wrong.
But Harvard's faculty, when surveyed, says 87% define themselves as liberal or very liberal.
Yeah, that's
87%.
I think I think any economist who has a who has a strong political position, is affiliated with political party, should hand back their degree. Okay, that's my view. They don't.
Well, by the way, so you and I both equally probably worry about the Fed and its independence and the extent to which it's becoming a political tool. I think you and I would both agree on that. Yeah, and which is a big problem. I think the Fed is going to, to get back to the investment side here a little bit, I think the Fed is going to continue to be very relaxed. You and I discussed before this podcast started, what is the Federal Reserve rate right now? What's the lending rate? And should it be lower? And yes, it probably should be. But by the same token, I mean, I honestly think that we're going to have a lot of stimulus here. I think we're going to have a lot of ignoring of federal debt, and it's one of the reasons I think the party's going to continue. Now, as I've described,
my most recent paper is on my website, kotlikov.net. It's a comparison of U.S. and Italian fiscal solvency. Italy looks like far better fiscal shape than the US.
Absolutely.
But anyway, Fred, this has been fabulous.
Right.
I have to bring it to an end, but we will have you back, and I will be taking you to lunch.
Great. Anybody who wants to learn more about Lane Generational, go to lanegenerational.com, click on Insights, which is our blogs about macroeconomic things in particular, or feel free to email me, call me. Happy to discuss what we do.
What's your email?
Fred at lanegenerational.com. Fred at lanegenerational.com.
What's your phone number?
617-835-4842. The website number is our main number. Call me on my cell phone. It's kind of where I live and die. 617-835-4842.
There's probably 500 funds that Fidelity has, mutual funds. There's not a single person running one of those funds that's listed on Fidelity, and they're not all Fidelity funds. Some are, where the person who's running your money will actually give you their telephone number and you can call them. So,
right. And I also would say one of the things that makes us so unusual, and it's a bit of a problem, is that our portfolio doesn't look anything like any investment fund, because all investment funds from a marketing viewpoint want to be technology, or they want to be value, or they want to be biotech, or they want to be medical devices, or and we don't do that. I mean, we basically
want to be successful.
we're unconstrained about what we do, geography, sector, and so on. So if someone said to me 5 years ago, you're going to be heavily invested in gold miners, I would have said, "Hey, you nuts? Not a chance in the world." And yet here we are. And if someone said to me 5 years from now, "Are you going to be heavily invested in gold miners?" I'd say, "I have no clue." I mean, I would actually say I doubt it, because it is a commodity ultimately. A little bit more than that. It's a store of value right now in a very uncertain world. But our portfolio will change year by year, or every 3 or 4 years, there'll be certain shifts. I mean, we used to be very but technology is so expensive now.
Yeah.
And our,
Okay.
so we just have a very different approach. We call it idiosyncratic, our approach.
That's cool. Keep at it.
Thank
All
you.
right, man. Love you.
Always,
Thanks so much.
always a pleasure, and love to Bridget. Talk soon.
Love you, Beth. Bye-bye.